Hello, and welcome to Insurance World TV. Over the last week or so, we have been asking this pardoning question. What if your investments could one day pay you every single month without you working? This video will show you how to turn income into assets and assets into financial freedom, an amount which, if invested prudently, can generate income for life and potentially allow you to retire early. In our previous video, we introduced the concept of the financial freedom number, what it is, how to calculate it, and the key factors to consider when determining your own. If you haven't watched it yet, make sure you check it out because it will give you the foundation you need to fully understand today's discussion. After that video, we received a lot of questions, with many asking, how do I actually reach this number? Where do I start? Is this even realistic in Kenya? So, we're going deeper. We're not just talking about the number. We're breaking down practical, real-world strategies you can use to build towards it, step by step. Whether you're employed, running a business, freelancing, or dealing with irregular income, this video is designed to give you clarity, structure, and direction. We'll show you how to build a clear, actionable path to your financial freedom number. No guesswork, no confusion, just strategy. If you want your investments to one day pay you a monthly income, then you need more than just a savings habit. You need a system that helps you build wealth, protect that wealth, and enables you to withdraw from it sustainably for life. The real question is, how much do I need to invest in Kenya so that I can safely withdraw income every year for life? That may sound technical, but I'll make it simple. We will break down the Kenyan platforms and accounts you can actually use to bid this portfolio, the types of assets to consider, and a step-by-step investment roadmap with real examples. So, if you've ever asked, how do I build a portfolio that can support financial freedom in Kenya? Then stay with me. Chapter 1. What a sustainable withdrawal rate really means. Let's start with the goal. A sustainable withdrawal rate is simply the percentage of your investment portfolio that you can withdraw every year without running out of money too soon. For many people, the most commonly used starting point is the 4% rule. This means if you have 50 million Kenya shillings invested, you can withdraw about 2 million Kenya shillings per year over a long period of time without running out. That's roughly 166,000 Kenya shillings per month, while still preserving your portfolio over time. But in a market like Kenya, where inflation, currency fluctuations, and market volatility are real factors, many investors prefer to be more conservative. That's where the 3% or 3.5% range comes in. For example, if your target is 1.5 million Kenya shillings per year, at 4%, you need about 37.5 million Kenya shillings. At 3%, you need about 50 million Kenya shillings. We have also extensively explained the 4% rule and its equivalents in this video. Feel free to check it out. So the real shift in thinking is not, how much money do I want to invest? But, how much income do I want my investments to generate every year? Chapter 2. Why the Kenyan context matters. Now, why do we need a Kenya-specific strategy? Because not all markets behave the same. Kenya has strong investment opportunities, but it also has realities every investor must respect. inflation that can change over time, a shilling that can strengthen or weaken, rising healthcare costs, and markets where some assets are liquid and others are not. That's why in Kenya, a sustainable portfolio should never depend on just one asset class. Instead, it should combine the following. Number 1. Income-generating assets for stability. Number 2. Growth assets to beat inflation. Number 3. Liquidity buffers for flexibility. And number 5. Currency diversification for protection. In simple terms, you need money that pays you, money that grows, and money that protects you. Chapter 3. The main asset classes to use in Kenya. Now, let's break down the key building blocks of a strong investment portfolio in Kenya. The first investment vehicle is government securities. Government securities, specifically treasury bills and treasury bonds, form the foundation of any serious investment portfolio, especially for someone pursuing financial freedom in Kenya. These are instruments issued by the government through the central bank, which means they carry very low default risk compared to most other investments. In simple terms, you are lending money to the government, and in return, the government pays you interest. Why are they so important? Because they offer 3 critical things: stability, predictability, and consistent income. Treasury bills are short-term, typically ranging from 91 days to 1 year, making them ideal for managing cash flow and short-term needs. Treasury bonds, on the other hand, are long-term, sometimes going up to 10 or even 20 years, and they usually offer higher interest rates, paid periodically. This is where their real power lies. If your goal is to build a portfolio that can eventually pay you a regular income, then government securities act as the engine room of that system. They generate steady, reliable cash flow, the kind of income you can plan around. Unlike stocks, which can fluctuate, or real estate, which may take time to generate returns, government securities provide a level of financial certainty. You know when your interest is coming, and you know how much to expect. So, as you build toward your financial freedom number, think of government securities as your income anchor, the part of your portfolio that keeps everything stable, even when other investments are moving up and down. The second investment vehicle is money market funds. Money market funds are one of the most practical and underrated tools in any Kenyan investment portfolio. They are designed to provide liquidity, stability, and easy access to cash, which makes them extremely useful, especially when you are building toward financial freedom. These funds invest in short-term, low-risk instruments like treasury bills and bank deposits. That's why they don't fluctuate much in value. They are not designed to make you rich overnight. Their real value is consistency and accessibility. This is where you keep your emergency fund, money for short-term needs, and the portion of your portfolio that should not be exposed to risk. Because when life happens, and in Kenya, it definitely will, you need money that is available immediately without losses. So think of money market funds as your financial shock absorber, always ready, always stable, always accessible. The third investment vehicle is equities, that is NSE stocks. Equities are what we call your growth engine. When you buy shares on the Nairobi Securities Exchange, you are essentially owning a piece of a company, like a bank, a telecom company, or a manufacturing firm. And over time, these companies can grow. And that growth translates into capital appreciation, dividends, and long-term wealth creation. Equities are powerful because they help you beat inflation, something low-risk assets alone may not achieve. But here's the reality. They are volatile. Prices go up and down. That's why equities must be used strategically, not emotionally. You don't rely on them for stability. You use them for long-term growth. So, in your journey to financial freedom, equities are not your safety net. They are your wealth accelerator. The fourth investment vehicle is global equities and ETFs. Now, if all your investments are in Kenya, then your entire financial future depends on one economy. And that's a risk. That's why global equities and ETFs act as your diversification shield. They give you exposure to international markets, access to global companies, and protection against local economic risks. For example, if the Kenyan shilling weakens, your offshore investments can actually gain value in local terms. That's what we call a currency hedge. So instead of being fully exposed to one country, you spread your risk across multiple economies. Think of global investments as your financial insurance against uncertainty. They protect your portfolio from being too local. Investment vehicle number 5. Real estate and REITs. Real estate has always been one of the most trusted wealth-building tools.
Why?
Because it offers two key benefits: rental income and long-term value growth. If you own property, you can earn monthly income while your asset appreciates over time. But there's a challenge. Real estate is illiquid. You cannot sell a house quickly when you need cash. That's where REITs come in. REITs, an abbreviation for Real Estate Investment Trust, allows you to invest in property without owning it directly. It is more flexible, easier to enter, and more liquid than physical property. So while direct real estate gives you control and stability, REITs give you access and flexibility. Together, they form a powerful part of a diversified portfolio. Investment vehicle number 6. Pensions and retirement accounts. Pensions are not exciting. They are not flashy, but they are one of the most powerful wealth-building tools available.
Why?
Because they enforce 3 things: discipline, consistency, and long-term thinking. With pensions, you benefit from tax advantages, structured contributions, and long-term compounding. Many people avoid pensions because the money is locked. But that's actually the advantage, because it protects your future from your present spending habits. You cannot easily access it, and that forces it to grow. So while pensions may not give you flexibility today, they give you certainty tomorrow. And in the journey to financial freedom, that certainty is priceless. The 7th and last investment vehicle we look at are the SACCOs, Savings and Credit Cooperative Organizations. Now, let's talk about one of the most powerful but often overlooked financial tools in Kenya, the SACCOs. SACCOs are unique because they combine disciplined savings with access to affordable credit. When you contribute regularly to a SACCO, you are not just saving. You are building borrowing power. Here's how they accelerate your journey to financial freedom. First, they enforce consistent savings. Unlike normal accounts, SACCO contributions are structured, monthly, predictable, and disciplined. Over time, this builds a strong financial base. Second, they give you access to low-interest loans, often based on a multiple of your savings. For example, if you've saved 500,000 Kenya shillings, you may be able to borrow 2 to 3 times that amount. This becomes extremely powerful when used correctly, because now, instead of waiting years to accumulate capital to buy land, property, or for a business expansion, you can accelerate your progress using structured, affordable financing. But here's the key. SACCO loans must be used strategically, not emotionally. Not for consumption, but for asset-building projects that can generate income or long-term value. So, in your financial structure, SACCO equals acceleration tool. Investments equals growth engine. Insurance equals protection system. Think of a SACCO as your financial leverage partner, helping you move faster toward your financial freedom number, without exposing yourself to expensive, high-risk debt. Chapter 4. The platforms and accounts you need. Now, let us talk about the actual accounts and platforms. The first is CDS account. If you want to buy government securities or shares in listed companies, you need a CDS account. This is your investment identification account in the capital markets. You can open it through a stockbroker or a licensed dealer, and you will typically need your ID, KRA PIN, proof of address, and account opening forms. This account is the gateway to treasury bills, treasury bonds, and listed shares. The second account is stockbroker account. If you want to buy or sell shares on the NSE, you need a trading account with a licensed stockbroker. This is where you place your orders for equities and REITs. The third account is money market fund account. For MMFs, you open an account with a fund manager. This is usually simpler than a brokerage account. You complete the KYC process, link your bank account, fund the account, and begin investing. The fourth account is unit trust or mutual fund account. If you prefer managed investing, unit trusts are a good option. With this account, you can invest in money market funds, bond funds, balance funds, or equity funds. The fifth account is offshore investment account. If you want to invest globally, platforms such as Interactive Brokers can be used by Kenyan investors who meet the KYC requirements. This may require a bit more documentation, but it gives you access to international markets. The sixth account is pension account. If you want retirement-specific investing, you may consider a pension product. This is important because wealth that is locked for retirement is often wealth that is preserved. The seventh account is SACCO account. You can open a SACCO account by joining one, filling in the application forms, and provide the required KYCs. These are the accounts that will help you in your financial freedom journey. Chapter 5. A step-by-step investment roadmap. Now let me make this very practical. Step 1. Define your target. Decide how much income you want annually. For example, if you want 1.5 million Kenya shillings a year, that is 125,000 Kenya shillings a month. Then decide whether you want a 3%, 3.5%, or 4% withdrawal rate. Step 2. Determine your required capital. If your annual need is 1.5 million Kenya shillings, at 4%, you need 37.5 million Kenya shillings. At 3.5%, you need about 42.9 million Kenya shillings, and at 3%, you need 50 million Kenya shillings. That becomes your portfolio target. Step 3. Open the right accounts. Open a CDS account, a stockbroker account, a money market fund account, and if suitable, a global investing account. Step 4. Build your base. Start with safety. Put some money into money market funds and government securities so you have stability and liquidity. Step 5. Add growth. Then build equity exposure. This can include NSE shares, global ETFs, and selected growth assets. Step 6. Add real assets. If appropriate, include REITs or direct real estate. Step 7. Rebalance regularly. At least once a year, review your portfolio. If one asset class becomes too large, trim it and restore balance. Step 8. Adjust your withdrawals. Do not withdraw blindly. In weaker market years, reduce withdrawals if necessary. In stronger years, you may preserve or increase them cautiously. Chapter 6. Sample portfolio structures. Let us make this even clearer. Conservative portfolio. This is for someone who wants stability above all. More government securities. More money market funds. Smaller equity exposure. Some real estate or REITs. A cash buffer. This may suit someone nearing retirement. Balanced portfolio. This is for someone who wants both income and growth. Bonds and MMFs for stability. Equities for growth. Some offshore exposure. Some real estate. This is a very practical middle ground for many Kenyan investors. Growth portfolio. This is for someone with time on their side. More equities. More offshore investments.
More growth assets.
Lower fixed income allocation. This works better for younger investors with a longer horizon. Chapter 7. Real-life example. Let us say you want to retire with 2 million Kenya shillings a year in income. At 4%, you need 50 million Kenya shillings. Now imagine this portfolio. Some money in treasury bonds for reliable income, some in money market funds for liquidity, some in equities for long-term growth, some in global ETFs for currency protection, and some in REITs for property-linked returns. That portfolio is not built in one day. It is built by consistent saving, disciplined investing, patient compounding, and regular rebalancing. That is how wealth becomes sustainable. Chapter 8. Key risks to watch. There are risks you must respect. Inflation can reduce purchasing power. Currency fluctuations can affect your real return. Equity markets can be volatile. Real estate can be illiquid. And healthcare costs can surprise you. That is why a good portfolio is not just about returns. It is about resilience. If you want to build a portfolio that can support a 3% to 4% withdrawal rate in Kenya, then the answer is not a single product. The answer is structure. You need a clear income target, the right accounts, a diversified portfolio, a realistic withdrawal rate, and a plan for risk management. That is how you move from simply earning money to building a system that can one day pay you. If this video helped you understand how to invest in Kenya with financial freedom in mind, share it with someone who is trying to build a retirement plan. And subscribe to Insurance World TV, because here we do not just talk about money. We teach you how to build it, protect it, and live from it.